markets have been on a wild ride for the first half of 2011. Old fears, such as weakness in the U.S. job and housing markets, as well as concerns about Europe's sovereign debt nightmare resurfaced, and new worries emerged, most notably the spike in oil prices after the Arab Spring uprising and fears of a prolonged slowdown in Japan following a devastating earthquake, tsunami, and nuclear crisis. But stocks have, for the most part, still held up reasonably well despite the volatility, and there are hopes that the second half of the year will be better for both the markets and economy. Joining me to discuss these memorable first 6 months and their outlook for the rest of the year, including a look at some of their favorite stocks, are David Katz of Matrix Asset Advisors and Paul Dietrich of Foxhall Capital Management. Thanks to both of you for joining me, and yeah, let's get right into it. The markets, as I mentioned, have been extremely choppy for the first half of 2011. Do you think that continues going into the second half of the year? Do we finally get maybe a sense of normalization where people come to grips with the fact that the economy is slowing down and we may not have as many fits and starts on economic data points as we had in the first half of this year?
Basically, we think the volatility is here to stay. We think that in the first half of the year, the volatility was on the upside, then the downside. We think the back half of the year, you might start off with a little bit of downside, but we end with strong upside. So we think when all is said and done, 2011 is going to be very much like a replay of 2010. Good upside returns, probably 10 to 12% for the year.
Right. Paul, do you agree?
I agree with that in general. We probably got a little bit ahead of ourselves in the beginning of the year with commodities and with the stock market. We're going through a normal and I think healthy correction. People forget that we've had 7 corrections in the last 27 months of over 5-6%. All of the things that are depressing the market now during the summer are really political issues that will get solved probably by whether it's the debt ceiling issue or the Greece crisis. It will get solved. We're looking at 15% growth in the next quarter for S&P 500 earnings, which is really good. And I do expect that the fall to the end of the year, we're going to have a really good stock market. I think one of the most interesting trends that we're seeing is an actual decoupling of the U.S. stock market from the underlying U.S. economy. You know, in 1960, only 5% of the profits of the S&P 500 companies came from outside of the United States. That meant we manufactured everything, we consumed everything, and if we sold 5% to the Japanese and Europeans, that was icing on the cake. Now it's almost 50%. So the U.S. stock market, the Dow and the S&P, they represent as much Asia and emerging markets as they do the underlying U.S. economy. And people are always asking me, why is the stock market going up when we have no growth or slight growth in the U.S., we have 9% unemployment? And the reason is that decoupling is that the growth is coming from outside of the United States, and that's where broadly the earnings are coming from. And I think that's largely a good thing that our stock markets represent the global economy now and not the U.S. underlying economy, because if it was just representing the U.S., we'd be in deep doo-doo.
How much support do you think the U.S. economy still needs from Washington, be that the Federal Reserve or Congress, even though we're in a political environment right now where everyone's talking about cutting the deficit and not maybe raising the debt ceiling by a substantial amount? I mean, you mentioned the eerie similarities to 2010 and that this is somewhat of a repeat scenario. Does that mean that the Fed saves the day yet again in the second half of the year with quantitative easing 3?
We don't think there's going to be a QE3. We think at this point the recovery is in a self-sustaining mode, and the Fed just has to keep easy monetary policy. They don't have to have a QE3. In terms of the federal government, we just hope that they don't do something stupid.
The Fed has basically indicated that they're not going to suck out the liquidity after June 30th. They're just going to let it there. They're going to roll over all of their sales for mortgage-backed securities, and that's going to go back. So there is going to be an easing, but it's not something that has to be approved by Congress, and it won't have a name. But I do believe that we're going to see increased liquidity, at least through the election.
Right. I've been somewhat surprised that the bond markets as well have not really indicated a sense that they're too worried about what's going on with the debt ceiling debate. It seems that you would think that if there was this real legitimate concern that the U.S. could possibly default, then long-term treasuries would be a lot higher than where they are right now in terms of what their rates are. Do you still, either of you, have a sense that the government will screw this up, Congress will mess it up, and despite the warnings from S&P and Moody's, we might, roll around in August and maybe not default, but come close to it.
Everyone has indicated, both the Republicans and the Democrats, that we are going to raise the debt ceiling. Either they're going to come to an agreement to substantially cut spending, which doesn't look like it's in place yet. And so there were indications by a number of key people who are negotiating now that they're just going to raise the debt ceiling up for perhaps 6 months or shorter, and then continue the negotiations. But we will not have a default.
What do you think, David?
We would agree. There's not going to be a default, but unfortunately, the negotiation is going to come until the 11th hour.